What's up everyone, it's Caddy with MoneyVest and markets here trading at all-time highs. Futures are also higher on the back of very strong Nvidia results. I broke down Nvidia's earnings in another video earlier today, so make sure that you do check that out. And the markets are just ripping higher and higher. And in this video, I've got a very important message for you because there's a research put together by DataTrek which goes over that in the 98 trading days, almost 100 trading days that have been in 2024, only 9 account for almost all of the gain in the S&P 500. So it's just really this idea of tail events that we're going back to again and again and trying to understand that most of the times markets do basically nothing. It's really just a very short period of time the markets make most of the movement that end up making all the difference in the investing world. So hope you all enjoy this video. And again, I broke down Nvidia's earnings in a separate video, but markets, boy, oh boy, we are ripping higher and higher. Futures are up almost 1% at the moment on the back of these Nvidia earnings. So again, make sure that you drop a like, subscribe to the channel. If you're just joining us for the first time, links to our Discord and Patreon is going to be down below if you're interested in joining. And again, 16% annual discount available until the end of this month. And also our individual courses are going to be 50% off. Coupon code May50 expires at the end of May. So link's going to be down below. We'd love to have you on board. So first things first, let's talk about just 9 days account for all the stock market's 2024 gains. Here's what they have in common. And this right here were the days. Right now there's 8 days. There's only 8 days listed on this report. But January 8th to January 9th, February 1st, February 22nd, March 12th, April 15th, May 3rd, and May 15th. And I'm assuming May 23rd is the ninth day where the markets are essentially accounting for most of this gain. And all of them have really 2 themes in common, and that is the exercise underlines that 2 themes: generative AI and expectations around the timing of the Federal Reserve rate cuts are driving market action. AI has been a reliable driver of gains, while speculation around the Fed has inspired both gains and losses. Worries over whether cuts would arrive were a major factor in the market's April swoon. And since the April sell-off, big updates have been more about anticipation rate cuts than tech sector news, and macro has also trumped micro outside the US with a weaker dollar and strong non-US equity markets as well. So the bottom line is 2 themes: artificial intelligence, Nvidia once again coming in strong with those numbers, pushing markets higher, lifting the entire semiconductor sector. And the second reason, the most important reason, being the timing of the Federal Reserve rate cut. What is the Fed going to do with interest rates? Are they going to raise, hold, cut? What's going to be the timing? What's going to be the intensity? A lot of the speculation around that is also resulting in markets pushing higher because in general, we like to be optimistic. We like to hope. We like to have faith that Federal Reserve is going to cut rates, and as a result, markets going to rip higher on the back of that quantitative easing. But of course, we've had some repricing risk because that was the reason why April was such a brutal month, because we saw a pullback and a dip because the markets had to reprice a lot of those things. Inflation continued to stay more elevated, and as a result, we did see a bit of a pullback. So going back, really the interesting thing here and the takeaway is that of the 98 to 99 trading days, only 9 make up for all the market gains. Just really helps us better understand why it's so important to stay in the market, right? As the saying goes, time in the market beats timing the market, because nobody can time the market well. Nobody can pick tops, nobody can pick bottoms. And it's so important that if you are investing, invest. If you're trading, trade. That's why, as any market participant, the first thing everyone needs to do is to figure out what their real strategy is. What are they really trying to achieve? What's their objective, right? At the end of the day, are they trading or are they investing? What's their time horizon? What's their risk tolerance? What's their financial objective? And that's why I've mentioned this before, but no 2 portfolios are ever going to be the same. They're always going to be different because no 2 people, no 2 market participants, no 2 organizations, no 2 funds, no 2 sort of market participants are going to be the same. They're not going to be the same on risk tolerance, financial objectives, time horizon, liquidity needs, tax jurisdictions, and the list goes on and on and on. There's so many different things at play here. That's why it's so important, in my opinion at least, if you're investing, stay in the market long term. And even, when you hear stats like, if you're investing for over 15 years, the probability of you losing money in the market, S&P 500 more specifically, is practically zero. There's a 99.5% probability that you end up making money over the long term or 15 plus year time horizon. And then again, other statistics like 83% of the times the markets are within 20% of their all-time highs. 48% of the times markets are within 5% of their all-time highs, right? So half the time the markets are literally within 5% of their all-time highs. So all these are really important statistics to always remember. The next time you see that bear market, the next time you see that sell-off, the next time you see markets pulling back or crashing down or getting dips or sold off or correction or whatever it is, take that as opportunities to buy. And I think I've been very clear in our previous videos when the markets are selling off. I've been very clear that it's time to buy. This is your buying window. Dollar cost average, be more aggressive, allocate more capital to the market, because that is where the most money is made. The decisions you make during times of distress when the markets are down is what ends up making all the difference when the markets are higher, when they're pushing higher, when we're hitting new all-time highs. That's when you're going to thank yourself that, oh, I made the decision to buy when we were seeing a 4 or 5%, 10%, 12% pullback or a correction. I took the opportunity to buy, and now I'm reaping on all the rewards here. So again, really important, very good analysis put together here that I wanted to go over. Now moving forward, there's a few more things that I want to touch on. So Charlie Belio also put together this research, which was very, very good. So there's about 100% chance the market ends up the entire year on a very strong note, on a bull market, basically on a green note. So S&P 500 is up 11.6% in the first 98 trading days of 2024, the 19th best start to the year going back as far as 1928. And the average, the gain, I don't think he's put together the average here, but if you take a look at the 19th best start, which is here in 2024, 11.6% or so in the first 98 trading days. Of course, we don't know what's going to happen in the next several trading days that are left on the year, and for the entire year, we don't know. But, however, this is interesting. For the full calendar year, there's been every single time, 20 out of 20, the markets are green. And not just green. They're actually green by a lot. I mean, 44%, 30.9%, 44%, 19.5%, 29%, 27%, 23%, with the exception of 1987 because 11.5% sell-off happened in the rest of the year. Still, the markets ended up green, 2.3%. 17.2, 26.7, 20%, 34%, 29%, 25.5%, 26%, 31%, 18.5%, 27%, and then 30%. I bet if we take the average or the median for all of these gains, we're going to be somewhere between 25 and 30%. Probably. We're going to be close to 20. There's going to be somewhere between 20 and 30%. So that simply means that there is potentially, and again, I'm not saying that's going to happen, this is simply based on stats and data, that there is a possibility that we see another 9 to 12% gain for rest of the year for the S&P 500, considering how strong historically markets have been when we are up 10, 11, 12, 15% on the year so far. Now, mind you that if you take a look at where we were in the first 98 days up until the end of the year, if the first 90 days were 29.9%, the entire year 30.9%. So we didn't really see a lot of gain rest of the year for that particular year. So really, I mean, this is the column that should tell us how much more of a potential gain can we expect. And only three instances out of 20 that we saw the markets get sold off, rest of the year. So it's 15%, meaning 85%. There's about an 85% probability that rest of the year we see more gains. And there's about 100% probability that we see the markets post a green year, right? So push 2024 and they are green on the year. So 100% probability that we are green on the year, 85% probability that we are pushing up to more gains, by an average of about, I would say, 9 to 12% rest of the year. So very, very good chart, gives you a little bit more perspective. However, the other side of the coin is markets evaluation. So this was Bank of America putting together this chart and suggesting that S&P is expensive on 19 to 20 metrics according to Bank of America. And these are all metrics that we've already, talked about on the channel. We've got a trailing price to earnings, trailing gap price to earnings. We've got a forward price to earnings. We've got a trailing normalized price to earnings, median forward price to earnings, Schiller PE, price to book value, enterprise value to EBITDA. You got trailing peg, forward peg, price to operating cash flow, price to free cash flow, enterprise value to sales, S&P dividend yield versus the 10-year treasury yield. Then we've got S&P in gold terms, Russell 2000 forward PE, S&P market cap to GDP. So a lot of valuation multiples that they've put together, and they've done a really good job actually. They've taken the current, they've taken the average, and this is how far they're going back to. Most of these are in the 1900s. So 1900s, 1832, 1986, 1960s, 1970s, 1980s, and this is the percentage above or below the average. And they're saying that we are expensive on almost all accounts except for ERP, that's the equity risk premium market based, we're 15.2%. This is still higher. This is still higher above the average because we're 582 basis points versus 505 basis points, I'm assuming here. And normalized ERP 216 versus 383. So our equity risk premium is the only sort of metric that they don't feel is currently overpriced or expensive. Everything else they feel like is, because trailing last 12 months gap price to earnings of 26.2 versus 15.1. And then we've got a trailing P of 22.6 versus 14.9. Forward consensus P of 20 versus 15.8. And the median forward price to earnings of 18.2 versus 15.5. So they do believe that a lot of these multiples are at an extreme. They are a little bit more on the expensive side. So market valuations are higher at the moment. Now, again, and I would argue that times have changed, right? And I'm not saying this time it's different. I'm just saying the times have changed. Technology was not a big piece of the puzzle back in the 1970s and 80s. Now technology is kind of having a very, very significant overweight on the equity markets. As a result, it's driving multiples higher. So not necessarily that we are seeing the overall market be overvalued, but it could be that technology is overvalued, which is resulting in the market valuations to be pulled a little bit higher, considering the weight that technology has on the entire market. So I would also like to see what the current averages are, excluding for technology, excluding for some of the more high flyers like NVIDIA, like Tesla, like even the likes of Apple. I would argue is 29, 30 times earnings is definitely higher because it's got a big market cap and it's pulling its weight. And I'm sure if you kind of exclude for Magnificent 7, we're going to be closer to like 17, 18 times earnings, which is not going to be as terrible as being 52% overvalued compared to its average price earnings multiple. Something to keep in mind, but valuations, I do agree. I think they are a little bit up there. Technicals are also a bit more overbought, but this statistic also does suggest there's more upside coming for the markets in 2024. So this right here was the entire market. So a little bit of a flat to / down day. We did see markets roll over. Most sectors were down, on the day. So again, almost all sectors were red except for healthcare technology. The last 1 week, a little bit of a split market. Last 1 month, most sectors are up except for energy, coffee prices, orange juice, feeder cattle, all pushing higher with palladium, lean hogs, sugar prices, silver selling off. And we got Bitcoin just a little bit under 70,000 and Ether just over $3,700 as well. So very strong momentum from these companies here. And then of course, coming over to the markets, S&P 500 continues to trade near all-time highs. RSI MACD also overbought, so just got to be super careful with where we are technically speaking. Futures are up 64 basis points for the S&P, almost 1% for the NASDAQ, and support level for S&P is going to stay put at 52.65. So this right here is going to be that level to keep in mind for S&P, down to as low as 51.87 for the markets as well. And again, talking about the NASDAQ, very much near all-time highs, RSI, MACD, and the L3 oscillator, everything suggesting for overbought conditions here from the market, and it's only going to increase right now, tomorrow, especially when the futures are higher on the back of NVIDIA earnings. So keep a close eye. And again, this right here is going to be that support level, sitting roughly at 16,500 for the NASDAQ as well. Very, very strong area of support and demand. Crude oil prices continue to slide lower, which is good. $77 a barrel is where we are. Really just consolidating sideways and starting to come down even further. Support level is going to stay put at $73, $74 a barrel for crude oil, and a resistance all the way up to $81, $82 a barrel for crude as well. So this right here was, of course, a head and shoulders, broke down, consolidated sideways, and then sliding down even further. So only going to be helping the situation with inflation. Volatility wise, 3.8% higher, so just a little bit over 12. Also keep a close eye on this, because if the VIX does spike with the negative correlation on the market, we could see a pullback on the S&P and the NASDAQ as well. But again, we're seeing a lot of consolidation on the volatility. So definitely paying attention to this very closely, because if the VIX does spike, there could be a pullback and a dip on the market, considering how overbought we are, overextended we currently are on the S&P and the NASDAQ as well. Now going over to, again, cryptos, Ether with a very nice breakout. Support level is going to stay put at 36.50. A lot of consolidation sideways in and around those prices. Next resistance and target is going to be at 4,000 for Ether, and Bitcoin, of course, trading at just a little bit under $70,000 after ripping higher. That is going to be that resistance at 72,000, and support level is going to stay put at 67,500 for Bitcoin as well. So a lot of consolidation sideways in and around that range for BTC. And then, of course, coming over to the 10-year yield, so 10-year treasuries, just consolidating sideways. So if you come over to the analysis here, of course, we got up to as much as 4.7.5%. Then we pulled back down to that area of support where we have previously validated at 4.3, previous resistance, and right now we're pushing back higher to 4.4. So really the 10-year treasuries have been consolidating in that range. Of course, we rallied higher to 4.7, then we started to roll over, and TMF, of course, is seeing a decent recovery from its lows of $42, $43, pushed up over 15, 16% at the moment, and so has TLT. Also, of course, pushing higher because of that inverse correlation, 5.5% higher for the TLT ETF as well. So talking a little bit about individual stocks. So coming over to Apple first, and Apple here starting to pull back a little bit, just over 190. And again, resistance is going to stay put as much as 195, 196 for Apple. Support level is going to stay put inside this green rectangle for the company. A lot of consolidation sideways in that range for Apple here. And as we have already talked about, the resistance and the target being at 194, 195, that is going to stay put as a resistance. Just be super careful with the technicals, because there's a lot of technicals within the S&P, more specifically the NASDAQ, that are now signaling overbought conditions. Look at the RSI, the MACD, the L3 oscillator for Apple here. So just got to be careful considering how overbought we are. We could obviously pull back here any day now. Amazon, on the other hand, already down, basically flat on the day. So RSI neutral, MACD's been selling off. So I'm not too concerned about Amazon. But of course, I could still see Amazon trade down to 171. So this right here is going to be that support level to watch for this company moving forward. Tesla giving back on some of the gains from yesterday, so coming back down. Support level is going to stay put at 178. So this right here is going to be that level to watch, with a resistance and a target up to as much as 196 for Tesla. So inside this red rectangle for Tesla as well. So a lot of consolidation sideways in that range, and that is going to be that next resistance and a target to keep in mind. That area of supply that we have talked about time and time again. Support level at 177 down to 153 for Tesla. Talking about NVIDIA, I've already done a separate video, so make sure that you do check that out. But a huge breakout to new all-time highs of well over $1,000. Support level is going to stay put at 971 down to 915, 912 for NVIDIA. Please make sure that you do check out that video. It's an 18-minute long full breakdown on NVIDIA and its earnings, and just absolutely a stellar quarter from the company. Advanced Micro Devices, support level is going to stay put at 164, 165 with a resistance and a targets up to 183. So that is going to be that level to keep in mind for Advanced Micro Devices. And like I said, support level is going to stay put at 163 down to as low as 150, 140 for Advanced Micro Devices as well. Talking a little bit about PayPal, and PayPal here on the day continues to sell off, down almost 3%, breaking down from this higher low, unfortunately, and that next support is going to be down as low as $57 per share for this company. So this right here is going to be that support level to watch, and as we already know, the resistance at 65 to as much as $68 for PayPal as well. So a lot of consolidation sideways, starting to see a little bit of a pullback, and of course breakdown from this higher low. Next support unfortunately is going to be at 57. Talking about Visa, and Visa here also consolidating sideways. Resistance is going to stay put at 282. So that is going to be that level to keep in mind. Support level is going to stay put at 265 for Visa. A lot of consolidation sideways for the company, and resistance at 282 as much as 290 as we've already discussed. I've actually got a video coming out on Visa very soon. We'll be working on this individual stock analysis on Visa here, more dedicated video on this company as well, with a full detailed analysis on the earnings and of course the valuation as well. Talking about Meta platforms, and Meta here consolidating sideways at that support in that area of demand here inside the green rectangle. So support level between 455 and 475 with a resistance and targets up to 513, 530 for Meta platforms. And again, a lot of consolidation sideways in that range down to as low as 386 for Meta. Talking about Netflix, and Netflix here, of course, got a little bit of a breakout to the upside. Support level is going to stay put down to 636, down to 596 for Netflix. And of course, we're seeing the RSI, MACD, L3 oscillator, everything pushing higher, trading near all-time highs, near basically overbought conditions. So just got to be super careful for Netflix here as well. Google, pretty much near all-time highs. Again, there's a lot of stocks that are at all-time highs. Amazon, Nvidia, Apple, Google, Netflix, right? So there's a lot of big tech, Magnificent Seven companies that are trading near all-time highs with overbought conditions. So what does that simply mean? We've seen this before, right? We've been here before. We've seen this before. And this just warrants a lot of caution and, of course, alertness to these types of price actions and the risk reward as well. Support level at 173 down to as low as 152 for Google. That's going to be a much stronger support area of demand, all the way down to 131 for Google as well. Talking about Microsoft, and Microsoft also near all-time highs on the 4-hour chart here, basically flat, but at resistance at close to 430. So this right here is going to be that resistance level to keep in mind. And of course, we're seeing RSI, MACD, L3 oscillator, everything near overbought conditions. Once again, even Microsoft, add Microsoft to that list of how overbought and overextended it currently is. And then finally, we come over to Enphase and Costco. Enphase had a massive rally on the back of, again, interest rate expectations coming down, renewable energy, once again, kind of being front and center, up 8.7%. We did see a lot of solar stocks, so renewable energy stocks were all higher. So this is energy, that's traditional energy. And if you come down to solar, they were all very, very green. So Sunrun, Enphase, SolarEdge, and First Solar, everything pushing higher. And Enphase here validating that support very nicely at close to $112, and resistance all the way up to 138 for the company as well. So that is going to be that next target for Enphase moving forward. And then finally, we come over to Costco, trading near all-time highs at the moment, pushing up over 12 basis points, so basically flat, but support level is going to stay put at 785 for Costco as well. So hope you all enjoyed this video and a complete update on the markets. The bottom line is that time in the markets always beats timing the market. And yes, and again, what we do with MoneyVest Index and understand the risk reward is not timing the market. As I mentioned before, I'm mostly always long invested in the market. I'm 16% cash. The risk reward ratios and the MoneyVest Index is really just there to help us better understand how good opportunities are, and just to turn the dial and deploy more cash versus less cash. That is it. So we're not getting in and out of the market with getting 100% exposure to equities and then 0% exposure to equities. We're kind of buying and then all out selling, buying again, all out selling. So that's timing the market. Staying invested in the market with fluctuating cash balances because we are feeling more optimistic about the risk reward or feeling less optimistic about the risk reward is where I believe most of the opportunity lies, right? That's where you can assess and analyze the markets in a more educated and opportunistic way, as opposed to simply buying with no understanding of price or simply selling just because the markets are overbought and trading at an expensive valuation. So that's why the risk reward comes into play, and it's super helpful in my decision making. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. Links to our Discord and Patreon is going to be down below if you're interested in joining us, and of course getting access to all the members only private videos. 16% annual discount available until the end of this month. So always happy investing. I'll see you all in the next video.